And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's the Hump Day edition of The Real Investment Show. Glad you're joining us this morning on your way to work or whatever you're doing, of course. If you're watching us on live stream, congratulations, you're not at work right now. But anyway, as we get ready to kind of wrap up this week already, week kind of going by quickly, and we are now right in the midst of earnings season. Yesterday, Netflix reporting earnings after the bell. Stock holding up here a little bit, missed on subscriber growth, and of course, really focusing more on profitability now. And again, outlook wasn't great for the company, but again, stock's been holding up here, fairly well overnight. So again, that's going to kind of not drag as much on the NASDAQ as was initially thought. But futures are pointing lower this morning, and that's just a function of, kind of where the market is. We've had a decent rally over the last 4 weeks. So again, market's kind of starting to get to that point where kind of running out of gas. And if you think about how market advances work, and we tend to forget about this over time, is that markets don't just go up and they just don't go down. And we tend to kind of get into this attitude that markets only go in one direction and they've got to do this or that. But really what happens is that markets work on very short-term cycles. We've talked about this before on the show, called bull stampedes and bear stampedes. And this is where you get a spat of buying or a spat of selling that comes along. And these generally last 15 to 20 trading sessions on average. So, if you kind of look at that, that's about 4 or 5 weeks on average that you get a rally in the markets, and you get a little bit of a pullback, and then you get another rally, and then another pullback, so forth and so on. And that's just kind of the way markets work over time. And so we've had about a 4-week advance here. If you kind of think about a car, you fill it up with gas and you're going to go take a trip, well, eventually you're going to run out of gas. Markets kind of work the same way. We've had a rally now for about 4 or 5 weeks. Market's kind of starting to run out of gas here a little bit. So a little bit of a respite here, a little bit of a pullback wouldn't be surprising at all. And that would kind of help set the market up for whatever it's going to do next in one direction or the other. But speaking of that, I thought this was interesting this morning. Again, we've talked about this lately. This is a lot of negative commentary right now. Yesterday, more articles out about coming recession, and there's certainly plenty of evidence to that degree. And we touched on this yesterday, this whole idea of rolling recessions, right? And that may be allowing the market to try to absorb some of these events. And it's just been a constant series of events, really since January of last year, starting with Russia, Ukraine in March, and then kind of going from there. We had big fallouts in the NASDAQ, a lot of stocks, the SPACs, the IPOs. It was just kind of one kind of rolling Bitcoin last year, kind of one rolling disaster after another. As the Fed was hiking interest rates, markets would sell off, and then they would rally back on hopes of a pivot, and then Fed would say, nope, no pivot, and we'd sell off again. And it was pretty much just a very rough year last year, and markets declined back to the long-term 200-week moving average. We found support right there. Market has been rallying, since then, now back above the 40-week moving averages. And this is just kind of that ongoing movement of the markets. And this is, while there's a lot of real bearish sentiment, as we talked about yesterday, the markets continue to perform actually rather bullishly. The long-term bullish trend going back to 2009, still very much intact along that 200-week moving average. Market is consistently trading above the 40-week moving average. That typically leads to higher prices when that occurs, and we're currently above that 40-week moving average now. So again, the underlying bullish action of the market is certainly there, but there's certainly plenty of concerns, as we said yesterday, about issues that are facing the economy. Tighter bank lending standards, rising recessionary risk, these type of things would certainly run contrary to this idea that stocks are performing more bullishly and holding up here. So again, markets are doing fine right now. There's nothing wrong with the market at the moment, technically. And as we kind of go through this earnings season over the next 2 weeks, we're going to have a bulk of the S&P reporting. We're going to get a really good handle on kind of where earnings are and more importantly, what kind of forecasts are for the rest of this year. But that's also going to kind of set us up here. Again, we're working on a 5th week of advances right now. If the market can hold here where we are, potentially move a little bit higher by the end of the week, we're going to have another week of advances, right? So 5th week of advances, that's a fairly long stretch. So again, getting a week or two here where the market sells off a bit, kind of resets itself, certainly won't be surprising. And again, that's going to happen. We're going to get this sell-off. And despite all of the other news, look, and again, if we kind of go back and look at the long-term trend of the markets right now, again, bullishness is still in play here, still moving higher. Doesn't mean that we can't get a 5 or 10% correction. A 10% correction would pull us right back to the 200-week moving average, that long-term bullish trend support. So again, a correction of 10% would not be a surprise at all. And in fact, in any given year, a correction of 5 to 10% is normal. So a correction here. So if we get into a weaker spat of economic growth this year, some other event occurs, another bank failure, whatever it is, and the market sells off 10% here, don't be surprised. That's going to be that's well within the context of normality. That'll put us back to this long-term bullish trend. And if the market holds there, then of course that'll be your next buying opportunity as well. So again, we have to put all this into context and think about kind of where we are and kind of what happens next. Again, I have no idea what's going to happen 6 months from now, nor does anybody else. And so all we can really pay attention to is what is the market telling us? And right now the market is telling us that, well, the trend is fine. There's nothing wrong with that. Again, when that changes, then we'll certainly want to change accordingly. If we wind up taking out this 200-week moving average and then setting a series of lower lows after that, we've got a real problem on our hands. And that's going to certainly warrant a much reduced equity exposure at that point. But right now, there's no indication of that. So betting on that to happen may not work out very well for you. So again, and this is why we focus a lot on technicals. Look, the fundamentals are important. Stocks are still expensive. Earnings are definitely declining, and they're likely going to weaken even more as we get through further this year, as the economy slows down, as inflation falls. That's certainly going to weigh on earnings. And that would certainly kind of foster this idea of another 10% decline in the markets as markets readjust for those lower earnings and lower profit margins. But that doesn't necessarily mean that stocks have to decline another 30%. They could, but it doesn't mean they have to. Again, this is how markets work over time, and this is how we have to pay attention to things and how we have to manage our money over time. Again, it's not about being bullish or bearish. It's about just understanding what market dynamics are doing. And this is what market dynamics are doing right now, and that doesn't necessarily agree with a lot of the more negative forecasts out there. Reading an article yesterday, that the end of economic civilization is just around the corner, and that's certainly not what markets are saying is coming right now. So again, this is why it's important to just try to separate the reality of what's happening versus what prognostications are. And look, it's fine to have prognostications. It's fine to talk about whatever it is that you think is going to come down the road here. That's okay, but that doesn't necessarily mean that's what markets agree with you on. And importantly, when we make money, we have to agree with what the markets are saying more than what we believe. That's always the big challenge. So again, just kind of pay attention to this, is that, look, right now, bullish trend still firmly in track. Nothing wrong with that. Coming up on the show this morning, we're going to get with Danny Ratliff, talk about taxes, because obviously tax day yesterday. Where's a lot of that tax money going? That's one of the big questions. We'll talk about that this morning and more right here on the Real Investment Show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Retirement's not what it used to be, and knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare, Thursday, May 11th, with Danny Ratliff and Richard Rosso. How will Medicare work with the insurance you already have? What are the deadlines you need to know for signing up for Medicare? Register now for our Transitioning to Medicare Lunch and Learn learn with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. I'm Lance Roberts. Sadie Ratliff joining me as well. So tax day yesterday. If you didn't get your taxes done, you're too late. But you need to get an extension filed.
You're not too late. You're just not on time.
And there's a penalty for that.
Correct.
So I need to try that around my house. When my wife's late somewhere, I'm going to start charging her a penalty.
Yeah.
Yeah,
I was wondering why that cot was in the office.
Exactly. Yeah. Anyway. So, taxes due yesterday. Interesting story out this morning from CNBC talking about the government wastes $247 billion a year in taxes. And I thought that was interesting because, in any business, if you just send money here or there or whatever, you eventually go out of business. You just can't print more. And kind of in government, it's just this idea of spend more money. And if you didn't spend enough, spend more money. But, it's things like they ordered $28 million worth of forest camouflage uniforms for the military for Afghanistan, a desert environment. And so there's just $28 million wasted that they couldn't get back. They erroneously just send checks and payments to people that, they didn't owe money to, or they had a contract with previously and they keep paying them even after the contract's over. Just simple clerical errors that the Government Accountability Office has, just uncovers on a regular basis, but nothing really gets done with it because the Government Accountability Office really doesn't have much power or manpower to force Congress into making changes on spending and budgets. But this has totaled up to trillions of dollars worth of spending over the last 2 decades that has simply just been wasted and gone. And this is just taxpayer dollars. So all these tax dollars you're paying in, you complain about where they go. A big chunk of it just goes to waste every year. $247 billion is not left pocket change, by the way.
Just in 2022.
Yeah.
You got to love the timing of these articles when they come out when everybody's writing checks to the government.
Exactly.
They become even more frustrating.
Exactly. But you know what? And here's something I don't understand about the IRS, right? What is this annual game that we have going on? Now, look, we have all of our W-2s, 1099s, all those type of things the IRS has. And they have it because when you submit your taxes, if you fail to report a 1099, they come back to you and say, this 1099 that you got from, ABC company was missing. You didn't report that. Well, if you have that information, why am I guessing at what taxes I owe every year? Why don't you just tell me what I owe you, and then we'll just call it that? Right?
Well, I think that they should at least have a system where it reports, hey, here's what we have for you. Are we missing something? But at the end of the day,
No, you're not missing anything. That's absolutely correct.
Well, listen, we don't want to play that game, right? There shouldn't be too many gray areas with that. Now, where the gray areas would pop up and why we're not just paying exactly what they say is because your standard deduction, you're itemizing.
But to your point, tell me what you think I owe you, and then I'll debate you. Don't make me guess at what I think I owe you.
Yeah,
right?
That's right. That's right. But then you may have smaller partnerships that aren't necessarily reporting properly, LLCs, things like that, where they are relying on you to provide that information. But yeah, it's super frustrating. But even more frustrating talking about the overspending in general, just from simple single payment errors, was $2.4 trillion over the last 2 decades.
Yeah.
So Government Accountability Office is supposed to go in and kind of balance the books, so to speak, which we know that the government doesn't do a very good job of that ever.
That would be the accountability part of that title.
Yeah, which is clearly undermanned, understaffed, or just negligent, right?
Right.
I mean, there's a problem somewhere along the way, and they're finding duplicate checks that were, like you said, to contractors, people that weren't supposed to continue to be receiving funds, but yet they still get the money. Now, I'm curious, though, when the Government Accountability Office comes through, are they going back and are they reclaiming those funds?
No. And that's apparently that's the problem, is that they don't have the manpower or the power, I guess, to go back and reclaim those funds.
So we just hired how many IRS agents?
A lot.
80,000?
Something like that. 80,000.
Why are we not putting them on something like this? And we're so concerned about taxing the rich, which we know are already paying the majority of taxes. A large percentage of the population pays no taxes whatsoever. Why are we not going out after money that they are erroneously spending? And why are we not holding them accountable?
Don't get me.
Sorry.
Yeah, no, you're just going to get me fired up here. So
we probably all get audited now. Great.
There you go, making sense again.
So, but look, this is kind of the ongoing issue about taxation in general. If you take a look at the top 10% of income earners, they pay about 90% of the taxes, but yet we feel like they don't pay enough in taxes. So, it's one of those challenges where, our tax system, is there, and it's, extremely complex, which allows for a lot of the things that we all complain about. But again, that we're going after, President Trump for taxes as an example, right? And, or Jeff Bezos or Elon Musk, all these other individuals, the tax code is the tax code. And as long as you're playing by the tax code, yes, there's a lot of benefits if you've got a really good tax accountant and you set yourself up properly. You can reduce or eliminate a lot of your taxations, and there's a lot of videos going around the internet right now and a lot of them are erroneous, so be careful with them.
Correct.
But you can set up LLCs that you can use to help shelter some assets. We talk about this a lot. If you own rental properties, so don't put those in your personal name. Put those into an LLC. You get the benefits of tax write-offs, expenses for the house, etc., and you can lower your taxable income. So, this is what people with wealth do, is they find accountants that understand the tax code and make the tax code work for them. And where the bottom 80% of income earners are basically going on to Intuit and going, okay, here's my 1040 and here's what I owe in tax. Okay, here's what I pay. There are advantages to understanding the tax code and working with somebody that can do that. You can wind up saving a lot of money, particularly if you're a higher income earner.
Yeah, but be really careful. A lot of times we make it more difficult than it has to be. So, I saw something the other day. You mentioned these erroneous videos.
Yeah,
and they're like,
a lot.
Okay, so here's what the rich do. You're going to go set up an LLC in the Bahamas. Then you're going to go set up another one in Wyoming. You're going to own this and that. Well, most people don't own all of that, number one. And here's how you're going to not pay taxes. But I will tell you exactly how to do it for a small fee of $249 a month.
Yeah,
up front for the next 5 years.
Yeah, exactly. There's always a little hook to this. I like the ones now where it's like set up an LLC and then the government will give you a loan, to fund the LLC. It doesn't quite work that way.
Well, clearly the Government Accountability Office is not checking this out. So, there may be something to that one.
That actually could be. Exactly.
I mean, so they're still spending $1.7 billion in maintaining empty government buildings.
That one though is probably true. Even if they vacate the building, if their lease,
correct,
is for a certain period of time. And again, the government tends to kind of lease things for very long periods. So yeah, not surprising they're having to maintain some of those that they're not
maybe
using.
you could put some of those IRS agents in there.
That
I don't know.
I'm sure that may be the case.
They're probably working from home.
Anyway, all right. A couple of things this morning. One of the things that we need to get into, of course, and really kind of talking about taxation as well, is, a lot of individuals are now kind of, moving towards that retirement age. In fact, I saw an interesting study out this morning talking about working past the age of 65 by race. And it was kind of going through Asians, Hispanics, whites, African Americans, and when they plan to retire. And a big chunk of people in this survey all plan to retire by 65. It's still kind of that age, right? We kind of all look at it, man, if I could just get to 65, I can retire, and it's going to be easy living after that. Of course, what really turns out to happen is that we all wind up working well past the age of 65 because we can't make ends meet. But that really kind of brings us up to planning. Again, we talk a lot about planning for retirement, making sure you have a plan, making sure you understand what that plan is, because again, retirement, when we speak about it, is this very nebulous thing. I'm going to retire at 65. Okay, great. But what does that mean? Does that mean no working at all? Like you're just going to sit on your front porch with your dog named Bo and, throw rocks at the squirrels? I mean, or does that mean you're just going to do something else that you really want to do and you're not going to work for the man anymore? So what does that mean? And then also, what does that mean in terms of income? What do you need to live on? And then again, this is one thing that we do a very poor job of, and particularly in the financial media, they're the worst, is that you have all these articles out about, if you can, if you'll just, depending on what age you are, if you'll save this much money a month and make 12% a year on your investments, you can have $1 million by the time you retire. Well, that's great, but will $1 million do the trick? Right? This is the one thing that we never talk about anymore, is like, well, if $1 million will generate 4% a year, can I live on $40,000 a year in retirement, including my Social Security? For some people, absolutely. Some people may be able to retire on half that much, right? Maybe they have $500,000 in the bank and they live a lifestyle that can be supported by the income that $500,000 can generate. Or is it going to require more? It depends on what your level of income is going to be at retirement. So when we come back from the break, though, I kind of want to talk about this because this is one of the most important strategies, kind of coming up now, but thinking about retirement and potentially having to navigate retirement in the near future, given all the uncertainty in the markets, the world economy, geopolitics, et cetera. We'll talk about the most important strategy right after the break. So don't go away. Be right back with Danny Ratliff. Oh, by the way, get by the website, realinvestmentadvice.com. Michael Leibowitz's second part of his article on why the death of the dollar is not happening is on the website now at realinvestmentadvice.com. So go check that out as well if you've been getting a lot of these death of the dollar stories lately. We go through two parts of why that's not the case. Anyway, be right back. I'm your host, Lance Roberts, with Danny Ratliff. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Retirement's not what it used to be, and knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare. Thursday, May 11th, with Danny Ratliff and Richard Rosso. How will Medicare work with the insurance you already have? What are the deadlines you need to know for signing up for Medicare? Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I'll put like $100 bill in my wallet just because, again, you break down on the side of the road, something like that. I'm old, right? So I'm a boomer. I just feel like I have more security if I have a little bit of cash in my wallet just in case.
The Real Investment Show podcast.
But as soon as I have cash in my wallet, my kids invariably ask me for money. I don't know how they know I have cash in my wallet, but they have a direct link mentally to my wallet.
At realinvestmentadvice.com.
My kids are psychic.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report, Candid Coffee, and Lunch and Learn replays, plus each day's radio show. Subscribe and bookmark our YouTube channel or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Market futures pointing a little bit lower this morning. Dow's down about 91. S&P's down about 17. Nasdaq's about 90, down to about 91 points this morning. Earnings coming in, mostly companies beating pretty handily estimates, and not really surprising because, again, we lowered estimates so much. Everybody gets a trophy, right? So Morgan Stanley, Travelers, others all kind of beating estimates this morning. So again, we'll see how that carries through. Again, it's the outlook that's going to be more important as we kind of start hearing what the CEOs say about the outlook for the near-term future. Are they expecting improvement? That's going to be the big question here for the markets. But just for the break, talking a little bit about retirement at the age of 65 or whenever you're thinking about retiring. But again, recent survey shows a lot of people expecting to retire at 65. Again, not everyone. Big chunk of the people. It's the survey was retire at 65, don't know, or not retiring at 65, and so. The majority of people say they're retired by they have the anticipation of retiring by 65. Big chunk say they're not going to retire at 65 because they understand they can't, right? It's just they're going to have to keep working. But this is one of the kind of the points that we're at right now because there's a couple of things that are going on that certainly impact potential retirement plans. And one of that is higher interest rates. It's kind of a dual sword with interest rates, higher interest rates obviously impacting market returns, but also provides you the ability to lock in higher incomes with things like annuities or CDs or bonds, et cetera. So again, it depends on your time frame to a retirement, but there are certainly things to think about. And this is kind of the important thing about having some understanding. And, we talk a lot on the show, Richard Rosso and Danny Ratliff on Fridays talk a lot about financial planning, healthcare, Medicare, Social Security. We have seminars and webinars on this stuff all the time because, this is a big part of the planning process of preparing for that retirement. But for so many of us, we don't really have a plan. We don't really know when we can retire with any type of real certainty, et cetera. So it's kind of just, throwing a dart at a dartboard and saying, yeah, I'm going to retire at 65, but I really have no idea what that's going to look like. And that's really more important now than ever because of higher inflation rates, because of higher interest rates. That changes some of the dynamics about what that financial plan and financial future will look like. And this is really kind of, banking stresses. That's another issue right now as well. But this is also kind of part and parcel of planning for that and the most important strategies for retirees right now.
Well, I think one of the bigger issues is that everybody expects to retire at 65, but typically people are retiring earlier. And so depending on the year, I think the pandemic has probably accelerated that a tad bit. Interested to see the new numbers that are coming out. But this is important because if we're retiring actually earlier, and what does retirement really look like? You mentioned this.
Yep.
Is it truly you are done? You're no longer working. Human capital is gone.
65, I'm done.
Yeah. I'm sorry. I just pulled up your plan, Lance. It just says it doesn't work.
I know it doesn't. My plan never works for some reason.
I know.
My plan is perpetually broken.
It is perpetually broken. I'm sorry. I wish we had somebody better to work on this for you, but
I understand.
But I think this is one of the tough things for many people because retirement has evolved substantially, and I think that's something that will likely continue as we're kind of navigating this economy and not really knowing exactly what to expect. There's a lot of turbulence out there right now, and so with the unknown and the uncertainty, I think people are a little bit more inclined to cut back when they can or where they can, but also continue to work. So we're seeing a lot of people, if they can delay retirement, they're trying to do so, or they're finding that side gig. And I think that's going to be more prevalent in the future as people, maybe they do retire early. We've talked about this, quite a bit, that you've got this generation that's taking care of parents, that's taking care of children, a lot on their plate. So, last segment you mentioned, how do you navigate all of this with the current interest rate environment? And I think this is important. I think there's a lot of people leaving a ton of money on the table. Number one, just from a savings account perspective. And we can get into that a little bit here in a bit. And some of the things that are going on, I'm actually a big fan of with the savings accounts, right? People taking money from banks that aren't paying you anything to institutions that are. We'll talk a little bit about what you should be looking for, maybe doing or not doing. But, in this environment, we're seeing a lot of people, and we've done this as well. We're buying short-term treasuries, T-bills, trying to get a little bit of additional yield here. But are we getting closer to a time where we want to start locking in longer duration, getting, maybe not getting as high of rates, obviously not with the yield curve still inverted. But when we start to look at planning, we have to be closer to rates peaking at some point.
Mm-hmm. Right.
Are we there? And should people begin to start adding duration to portfolios because of that? And maybe you don't time it perfect at the top, but longer term, you're going to have number one, lock in that income. Number two, appreciation, right? So for somebody right now in this environment, do you go ahead and start looking for the longer duration, start stepping out? Because what I'm seeing more and more people do is, looking at short-term CDs, short-term treasuries. This has been easy. It's been nice to do, but we're still in, where the shorter end of the yield curve is still climbing up a bit. And so we're seeing that creep. Shoot, yesterday we saw the 3 months shoot up by like 10 basis points. I'm not sure where it closed, but
yeah.
So I think people have been really inclined to lock in shorter term. What do you do, and how do you start looking out for the future when you're planning for that?
No, I think that's a huge mistake that people are making too, is that everybody's running out. It's like, oh, look, I can get 4% on a 1-year T-bill. That's great. What are you going to do after the 1 year's up, right? When you can lock in 3.5%, 4% on a 10-year Treasury, particularly when rates were higher, that's what you should have been buying, is buying the long duration treasuries. Because again, you're locking in at least a 4% rate of return over the next 10 years. So if everything goes wrong, you've got a 4% net return on your money over the next 10 years. If interest rates fall, you're going to pick up a good bit of capital appreciation. So again, people are very short-sighted in general when it comes to investing, and they run out and they just try to grab something that's really short-handed and easy to do. And again, it was not surprising, right? It was all over the media, right? It's 1 year Treasury bills paying. Like, why don't you just do that right now? Because the market kind of sucks. I'll just throw my money over there. But the problem is what are you going to do when rates come back down again? And they will. Yeah. And yields will come down. And look, if you're in the camp we're having a recession, yields are going to come back down to 1% or less if we have a recession. It's just a function of how yields will work. So it's going to be, very interesting. And again, this is the big debate right now: recession or no recession. Can the economy avoid a recession? If it can, then that may suggest that rates stay a little bit higher than we would expect. But over time, rates are a function of inflation and economic growth, and those are definitely slowing. So yields are ultimately going to come down, which is going to make it harder to generate yield from fixed income when you get into retirement.
Yeah, and so I hear a lot of people saying, look, I'm going to go in and I'm going to invest. I'm going to buy these T-bills here for short-term or short-term CDs. I'm not going to worry about it later on. I'm going to go back in and buy stocks once those mature. I don't find that that's always the case, right? Especially because if we get into what many people think and we are in a recessionary environment, most people, I know you say you're going to go buy, most people won't. Right? I mean, it's just human nature. We don't want to buy things when they're down. We're more inclined to purchase things when they've gone up versus when they've gone down. But, number one fundamental rule, buy low, sell high. Mm-hmm. It's tough.
That is very tough. Well, and again, this is always the psychology of the markets, right? When we come back down and look at how we behave as investors. Dalbar, which is a company that studies investor behavior, they've been doing this. They publish an annual report every year. It just came out just a month or so ago for last year. But going back 30 years, investors underperformed the market by about 4% on average. And this is because of what they call the guess right ratio, is that investors always guess wrong about what they expect the markets to do. Oh, market's going to go down because of all these reasons, and then the market goes up. Or market's going to go up for all these reasons, and then the market goes down. Trying to predict the markets, and this is what I was talking about in the first segment, there's a lot of bullish trends that are setting up in the markets that suggest markets are going to move higher. Now, it's hard to imagine in an environment where we're talking about bank stresses, inflation, Fed hiking interest rates, all that. There's certainly, and look, economic data, there's certainly lots of arguments against that, but the market's telling you one thing, and we're looking at all these other economic fundamental factors, which, look, one of them is going to be right. I don't know which one it's going to be. But then that's the problem. We try to guess at which one's going to be right, and we tend to guess wrong, and that's what Dalbar shows us over time, and that has a big impact on our retirement.
So this could be a good time to start adding that duration to portfolios with the understanding that, hey, you may not time this perfect, but if we're looking out longer term, we want to lock in higher yields. I mean, we've been waiting for higher yields for over a decade, to really see yields where we feel like we can keep up with inflation. Now, granted, obviously, that's not the case at the moment, but over time, we're seeing that this has been a lot stickier than anticipated, but we're going to see this come down some over time. And so this would be one of those avenues that I think that are areas that you could start to explore adding some of that duration to it. You mentioned looking at annuities. We're still seeing at this moment where a lot of people can go out and buy a single premium immediate annuity with the cash refund versus doing their defined benefit plan from work. And that has not always been the case. So, there are options where there have not been options in a very, very long time. So I think it's worth exploring and understanding exactly where we are in this yield curve and the cycle, that this may not go on forever, and clearly it will not. Right. But if you're in the camp of a recession, like you said, rates are going to come down. We're getting closer to needing to lock some things in, is what I'm getting at.
Don't disagree. All right, quick break. We'll come back. Apple Pay has taken a new step in an interesting direction that could actually impact banks. Talk about that when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Retirement's not what it used to be, and knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare. Thursday, May 11th, with Danny Ratliff and Richard Rosso. How will Medicare work with the insurance you already have? What are the deadlines you need to know for signing up for Medicare? Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So I want to talk about Apple Pay here real quick, but just a second ago on one of our news channels here in the studio, talking about Netflix, of course, who reported earnings last night. They're going to end their DVD by mail service, which I didn't even realize was still a thing that was going on. But that got Danny and I talking a little bit off air about about Blockbuster. And I remember when, and there's one Blockbuster left. It's like in Alaska. And people still go there to hang out and talk with friends and things like that. But that used to be the big thing on a Friday night in my house when we were growing, when I had a lot of little kids, was we take all the kids, we go out to have dinner, like at Chick-fil-A, because it was cheap then. It's not cheap anymore, but it was cheap back then. I could feed like the whole family for like $10 at McDonald's, right? But anyway, we take the kids out to eat, and we go to McDonald's, to Blockbuster, and let them roam around, pick up movies, and we go home and watch movies as a family. And it was a lot of fun. It was kind of just good family time, and I do kind of miss that part about Blockbuster. We just don't have anything like that now. So
interesting. So I was Googling that while you were talking about it. So there is one last one. It's in Oregon.
It's in Oregon. I thought it was Alaska.
And I thought so too. And now you can actually rent this out as an Airbnb. Yeah.
Well, you have a good movie selection, apparently.
I mean, this is just, this is not verified. So if there is one in Alaska or wherever else, sorry.
Maybe. Yeah. So that would be kind of cool, though. You rent out an Airbnb that's an old Blockbuster, and then you just have, a movie party. You have every movie on the planet, pretty much.
Yeah, so it offers movie lovers in Bend, Oregon, a 90s themed sleepover for a limited time, only on Airbnb.
Interesting. $60 billion. That's how much Charles Schwab, State Street, and M&T have suffered in lost deposits. Now, I don't know about M&T and State Street. We don't really do a lot of business with them, but Schwab we're intimately familiar with, and not surprising. In fact, we've been in a big process of moving our client accounts from Schwab to Fidelity because of primarily one reason, which was money market rates. Money markets at Schwab pay, what was the latest read on that? 0.01?
No. So the
Schwab,
average money market out there, or U.S. savings accounts, paying 0.37. But at Schwab, the problem was it's a retail investor versus an institutional investor. They give you a little bit more options, and we have options as well. But they don't make it as easy to use as other institutions where basically the reserve account that they use for money market with institutions pays almost nothing. It's like 0.40, give or take.
Yeah.
Whereas, so we can go buy another money market, but it's
not liquid.
It's still liquid.
It's
just not as liquid
it's
where
not
we're
a sweep
trading.
account. Yeah, exactly.
Correct. It's not a sweep account. So this is something though that many people don't know about. So if we talk to people and we see people that have accounts at different institutions, a lot of times they are sweeping you into their bank account that, yes, it's FDIC insured. That's great.
Pays nothing.
But it pays absolutely nothing. And
versus other brokerage firms that pay 4.25%.
Yeah. So, and they haven't always done that, but they're doing that now as we're seeing rates increase. Money market at Fidelity right now is 4.51. You can actually find and get some that pay more. They may not offer as a sweep, but you can certainly store money in other places and get a little bit of yield on it. So what we're seeing now is it's interesting because the dynamic has shifted some. We've seen a lot of people who've been moving money from institutions that pay you nothing to someplace that will. And so this is one thing that I love because I think that, look, we have to fight for every dollar we can get. Don't be lazy and leave it sitting somewhere where they're not passing that on to you.
Yeah.
So we're seeing a lot of financials where earnings have looked great. Looking at the big banks have actually picked up some market share because people have been scared, right? So since Silicon Valley Bank, Signature Bank, all this news that's out, they're saying, whoa, shoot, I don't care. I just want my money to be safe. So I'll take it to the big institution. But we're seeing a lot of people, and that's what the preface of this article is. But on the flip side, I'm seeing a lot of people who are taking money from those institutions to put it in the money market to get more yield, to have more flexibility, to have more options. So, the way I look at this is that you need to start moving funds. And so we were talking about last segment how, look, maybe do you start going out longer in duration? Yes, absolutely. Do you also start looking out for money markets that are actually going to pay you something? It's a no-brainer.
Yeah. Well, again, this is something that people are becoming much more aware of now. And before, they weren't really that aware of it, right? It's because nobody paid anything on interest rates because the Fed had cut rates to zero. And nobody paid anything on money markets. So everybody took money out to go buy equities with it, which is kind of what the Fed wanted anyway. But now all of a sudden, because we're talking about high interest rates and now every commercial you see coming on is we pay, X percentage on our money market fund or whatever it is. You're now seeing this. And of course, the big news yesterday was Apple Pay, which has now launched a money market account of 4.15%. And this is through their relationship they have with Goldman Sachs. But think about all the users that have an Apple iPhone that can go into Apple Pay and all of a sudden they've got access to a 4.15% money market account. How easy will it be to swap money over into that account? And think how good that is for Apple on all their products, because now it's like the money's right there. How easy is it to upgrade your phone or buy a new service or add to whatever it is that they're selling you? Certainly makes that access to that money a whole lot easier for them to sell your product. So genius move by Apple, which is why we continue to own Apple stock. But again, this whole move to, another option here, a 4.15% money market is going to start dragging more and more money from other banks. And Apple, the size of Apple, it's not going to take long for them to rack up a few $1 billion in assets.
Yeah, if you go peruse their website, it's interesting. It's not actually too easy to find, but not that difficult. But 4.15 is really nice. But what Apple's doing, you have Apple Wallet. You can store just about any and everything there. You have Apple Pay, so almost like a Venmo or PayPal where you can use that. But you can also go up to a lot of checkouts and actually pay with your phone. I've seen and heard stories of people doing that where they leave their wallet, they use that. And then now this is just another kind of feather in their cap, I think. What's interesting to me, though, Lance, is that if you go to Marcus by Goldman Sachs right now, they're paying you 3.9%. Versus with Apple, they'll allow 4.15. So I wonder what type of an agreement arrangement they have here.
Yeah, exactly. The average U.S. bank account savings rate, I'm reading from an article, is just 0.37%, according to government data, versus the Fed benchmark of 4.75%. Schwab on Monday said deposits fell 11%, or $41 billion in the first quarter, or 30% year on year to $325.7 billion. Custody Bank, State Street's total deposits fell 5%, and of course, $4 to $5 billion of outflows of non-interest-bearing deposits could leave in the second quarter. M&T reported bank total deposits declined 3%. But this is why these banks, by the way, are reporting, like J.P. Morgan, 49% increase in net interest income, because they're picking up that spread between what they pay you, 0.37, versus what they charge and are receiving from either the Federal Reserve in terms of interest income on deposits, or what they charge people that they loan money to. So that spread is where they pick up that net interest income. And when they're not paying you anything for storing your deposits, and they have a big spread on investment, of course, net interest income is jumping. And that's, but sustainability is also going to be a problem. JP Morgan, yes, reported a huge jump in net interest income, but what happens when the Fed starts cutting rates? Now they're going to have their reports going, oh, we had a big decline in net interest income, and that's going to impact earnings. So again, it's a two-edged sword that is not going to stay for very long. But right now there's an opportunity, like Danny said, to pick up some money on deposits. All you do is just have to, take some type of action to move some money somewhere. You may you may be at JP Morgan, love their bank. Doesn't mean you have to store all your savings there. You keep a little bit there just to keep your relationship, but then there's plenty of online banks right now, FDIC insured, et cetera, that'll be happy to pay you on your deposits.
Ideally, you need to be using those institutions for your day-to-day activities, your credit cards, your checking account, hopefully using your credit cards, earning miles, getting points, paying it off each and every month, using the savings or the savings somewhere else. So you mentioned that the average industry interest rate right now is 0.37. But at Chase, their premier standard rates are 0.01.
Yep.
Now, if you have a premier relationship, they will double that.
To 0.02.
To 0.02. Correct. So you're getting absolutely nothing. So unless you're going to need these funds like really quick, go find somebody that's going to pay you for it. Because that's why you talk about earnings. Mm-hmm. You mentioned this, what they're bringing in versus what they're paying out. That is a big number.
Well, and maybe if, this is kind of like with what's going on with Bud Light right now. Obviously, people making a vote with their dollars and saying, we're not going to buy Bud Light because we don't agree with your views. If enough depositors start taking money out of these major banks and moving it somewhere else where they can get a higher return on deposits, trust me, the banks are going to wake up and pay attention and go, yeah, maybe we should start paying our depositors some money to keep them here. Because look, at the end of the day, they need those deposits. Regardless of anything else, they're a fractional reserve banking system. So they need those deposits in order to loan that money out to create business loans or whatever it is. And if you extract enough of those deposits, that creates that stress on the bank to where they have to make a choice either to start paying you or doing something else, right?
But Lance, if I move my money, I'm going to lose my private client status.
You may.
Whatever it is. Well, that's the argument I always make.
What are you getting for it?
What do you actually use from that? Many people don't use hardly any of the actual services, and they're very minimal. They're actually what they should be providing you anyway. And the interest you would be making somewhere else, depending on the dollar amount, I'd probably make an argument that you'd be better off getting more yield, paying the $35 wire fee or whatever it is that you may do once a year.
Yep, there you go. All right, that wraps up the show for the day. Danny, thanks so much. Get by the website, Michael Leibowitz's latest article. It's part 2 on this whole notion of the death of the dollar and why that may not necessarily be the case. So if that's something that's been weighing on you, Mike's written a really good 2-piece article over the last 2 weeks covering that. So go to the website now, realinvestmentadvice.com, click on that article. While you're there, send your questions, comments, emails. We're always happy to help you any way that we can. If you have questions about retirement planning, etc., Danny stays up all night answering those emails. So be sure and send lots of them for Danny. We'll make sure and get those to him. Anyway, have a great day. We'll see you tomorrow right here on The Real Investment Show.